Welcome back to Rich Dad StockCast. I'm your host, Denney, and today we're talking about something that impacts every dollar you earn, that you save and invest, but most people truly don't understand, and that's the Federal Reserve and monetary policy. You've probably heard of terms like inflation, interest rates, and money printing, but here's the reality. These forces are quietly shaping your financial future every single day. And here's the uncomfortable truth. The system is not designed to reward savers, it's designed to reward asset holders. Now, today, Rich Dad expert Andy Tanner is here to break down how the system actually works, how investors can position themselves to benefit instead of just falling behind. And before we dive in, go to stockcastbonus.com, grab your free investing tools. If you want to understand how money really works, that's where you start. Andy, welcome back.
This is going to be a great conversation, Del. I haven't spoken about the Fed in a long time, and there's been so much other things in the news that they've been pushed aside a little bit. But what Chairman Powell does and those decisions they make affect us. So this will be great.
There's a lot of decisions to be made. Now, before we jump into a can of worms here, and I'm excited for this, stockcastbonus.com, a lot of goodies there. What do our listeners receive when they go?
They get to pick up all their free stuff. We've got free stuff there. Right now, we've got a really powerful ebook. It's life-changing, helps people implement, and it gives them the tools and the recipe. It's a habits book, and it shows you a couple of simple habits, a couple of simple things to pay attention to that create wealth. So that's available.
Fantastic. All right. So let's start here. Foundation question. What does the Federal Reserve actually do? How does that affect everybody? Like, I know it's a broad question, but let's start with the foundation. What is the Federal Reserve? What do they do?
Well, they're in charge of monetary policy. They make the policies regarding money. They have a lot of different levers they can pull. If you ask them what their mandate is, they have a dual mandate, almost a threefold mandate. But the dual mandate is they very much care about maintaining employment. They like to see what the unemployment number is, and if it gets too big, then they do their thing. And then the other thing is price stability. That doesn't mean price is frozen. That means they don't go crazy. And then the third one really isn't a mandate. The dual mandate is jobs and price stability. But the third one you could say is they try to get a rate, a loan. They're a lender of last resort, you might say, and they try to put a floor on interest rates. So they do control the floor of the global interest rate. And so they have a lot of power because of that. So a lot to learn about the Fed. Very important to understand them, actually, in my opinion.
Well, I agree. I think it's really important to understand, and maybe some people brush it off of just, I see it on the news and whatnot. I hear, yeah. But really, I think maybe another good question to ask is, why should this matter to me? Or why should this matter to the average investor?
Yeah, a lot of reasons. First of all, as a collective, when you go into a voting booth, if you're part of the electorate, my personal opinion is the more you know about policies, the more you can make your choices more informed. So that's a big deal. But as an individual, every single thing that you buy, if you buy things, which is everybody, you care about prices too. And as an investor, saying just the average person, well, as a consumer, you should care about it because it attacks your savings and it makes it harder to buy things at the grocery store and the gas pump. As an investor, it's way important to know what their policies are because much of how I position my financial statement has to do with what I believe the Fed does and tries to do. So it's not a small thing, and it is something that everyone, at least that's interested in money, should know the policies that surround it, monetary policy. So that's what I believe.
Now, you mentioned interest rates, and we always hear, interest rates, this and that, the other. But how do interest rates and money supply affect the economy?
Well, it's about money supply. So let's think about the availability of credit. What would happen if I, if I was king and I had my scepter and I declared a law that said there is no more mortgages. If you can't pay cash for a house, you can't have one. So save your pennies until you pay cash for a house. So if you removed that availability of money, and you took away that supply of money that's available to people, what would happen to the prices of homes if the only way to buy one was to purchase, make a cash purchase instead of using some funding or some debt? What would happen? Obviously the market would collapse. There'd be no demand, not because people don't have a desire to live in a house, because they don't have the abilities. Demand, we might look at supply and demand. Look at demand side as sort of a two-pronged idea, that I would have a desire to have something, but you also have the ability to have something. So if you look at the inability to buy certain things, you price people out of the market. So if you say, well, okay, people can't afford $2 million for a home, so we'll loan them the money. Well, that allows a lot more people to participate, and that drives prices higher, actually, because it gives people the ability to buy. Think about college tuition. We've decided to do all these student loans, which is probably the worst loan ever. I mean, you don't have a job. There's no employment. There's no collateral. There's no guarantee of employment. Student loans are brutal. But if you give everyone grants and loans, then everyone can go to college, and that drives the price up because everyone can go. There's more demand for it. So we should care very much about the Fed for those reasons. And that's why a low interest rate allows people to buy more stuff. So if they want to stimulate things, they'll drop interest rates. But when you can buy more stuff, well, that can drive inflation. There's a risk of inflation there. So they have many levers that they pull. One of them is interest rate, to say, let's make it easy to borrow so we can flood, the world with money, or we can make it hard to borrow, and there's less money available in that supply.
Now, you brought up an interesting word, inflation, and we hear that all the time on the news. Now, my question is, why do savers feel like they're always falling behind, even when they're doing everything right? They're doing everything that they told, they're saving, yet they're behind. Why is that?
My dad has been retired for a number of years. He's in his late 80s. He's about as far into 80 as you can get before you go to 90. And after COVID, my dad was the type of guy that would put money in a shoebox and put it in his gun safe or something, And I just talked to him. I said, Dad, that cash is actually shrinking. I know the number of dollars is the same. When you count the number of dollars, that doesn't change. But if you try to take it out at the grocery store, it's going to buy a lot less. And that year, when the COVID got away from us, as far as inflation went, we had double-digit inflation in my home country, the United States, 10%. So I told my dad, I said, he's not much of a stock guy, but I said, Dad, at least go get an I bond where it'll be inflation adjusted, and you can get 10% on your money right now on an I bond. And that will help keep pace to where that cash can retain its earning power, right? Or at least you'll have more cash to spend, rather, because in a shoebox, it's not going to multiply. So yeah, it's a big deal for savers. Think about it this way. What if I took 2% of your wealth every year? What if I just said 2% of your assets are now mine? Well, that happens in two ways. Number one, it happens with taxation. I mean, you get a certain amount of assets every year, and that paycheck goes to the government, so you lose it there. But you also lose it through inflation. They have a goal at the Fed of about a 2% inflation rate. That's what they want. So their whole monetary policy is designed, they don't always execute it, but their wish would be that everything you have would, in the bank would lose 2% of its value every single year. So think about it. In 10 years, what is that? In 30 years, what is that? So savers, Robert Kiyosaki often says savers are losers. He's not saying that to be, you're a loser. It's just they literally lose. It's just they have a loss. And so savers are losing. They're losing their buying power.
Now, on the inverse, why do stocks and real estate and businesses tend to benefit from inflation?
Yeah, I love it. Start with real estate, and I leave that to people like Kenny and Kim Kiyosaki, Robert Kiyosaki. They're better at real estate, but I own real estate as well. Don't own it as much as they do. But Warren Buffett once said it this way: I don't look at it as the property gaining value. I look at it more as the dollar losing value. I look at the debt side of real estate more than the square footage or whether I have a tenant in common or, any triple net, all that stuff to me is ancillary to the dollar loses value. So let me put it to you this way. If you asked me where Apple Computers was going to be, in 2, 3, 4 years, I couldn't tell you. I'd imagine it'd be higher, but I couldn't, who knows what's going to happen in the market. But if you ask me where I think the dollar will be in 30 years, down. Dollar will lose value. The Fed is trying to take 2% of its value out every single year. So over a 30-year period, we're going to be, sounding like our dads. I remember when I get a hamburger for 25 cents. We'll say, we remember when gas was $4 a gallon. Right? So if you want to really understand how net worth is increased, there's really two ways to do it. You either add things to the asset column that increase in value, or you add things to the liability column that decrease in value. In other words, if I put more stuff in my asset column, and that's going to add value to it. If I put more stuff in my liability column, but that stuff is getting less valuable, that increases net worth too. Think about that. Increase your assets, increase your net worth. Decrease your liabilities, increase your net worth. So by buying things or borrowing things that go down in value, we get to take what's called a short position. And that's how shorting works. You borrow stuff that you think is going to go down in value. It's that simple. So Warren Buffett once said this. He said, maybe one of the best ways to short the dollar is to borrow it and buy real estate, because the real estate can fund the debt, but you're paying the dollars back in dollars that are worth less. In other words, you borrowed them when they're fat and juicy, traded it for an asset that was fat and juicy, but now as you pay that back, you're paying it off with dollars that are smaller than the dollars that you borrowed. So I think that's a better hedge than gold. I think it's a better hedge than precious metals. I think debt is the best hedge against the falling currency you could find, as long as that debt is being traded for an asset that can cash flow. If you look at how that money travels, Dell, if you just look at the cash flow pattern, we should draw one. This is why we have classes. Is you touch all four columns. Look at this. Borrow money, that's the liability column. Trade it for an asset, that asset column. Rent the house, turns it back into money, that's the income column. Repay your debt, that's the expense, that's the mortgage. So you have asset column, or you have liability column, asset column, income, expense. It flows that direction, liability to asset to income to expense. Well, those four steps are how you short anything. Stock, you borrow it, you exchange it back in return. So that cash flow pattern is a shorting of the dollar cash flow pattern. And that's how I see it. I see it more as, how can I use the debt as opposed to I want to be a landlord. To me, it's about that very, very sexy cash flow pattern. Because here's why. If you want to increase the net worth by buying assets, you have to have money to do that. But if you want to do it by decreased liabilities, in other words, the value of the dollars going down, you could borrow as fast as you want, as much as you want. So again, I part ways with Dave Ramsey very quickly here. The fact he can't see that the short position on a currency that is going to fall by mandate, by policy, right? The Fed says this currency is going to go down in value, and we're going to work as hard as we can to make sure it happens. We're going to print, we're going to lower interest rate, we're going to keep borrowing money on the fiscal side. I just don't see any way for the dollar to increase in value over the next 30 years. I just don't think it's possible. So I want to borrow as much as I can, as fast as I can, Dave Ramsey. If you understand the short, and this is not me, this is Warren Buffett. He says it's a great way to short the dollar. So I'm not going to argue with Warren Buffett. Ramsey can if he wants to, but I'm not going to argue with Buffett. Buffett's smarter than we are. We should listen to him.
That makes sense to me. Now, let's do this. Let's take a quick break. Listeners, if the system is designed the way that we're describing, then the real question becomes, how do you position yourself on the right side? So when we come back, Andy's going to break down how smart investors think about inflation, interest rates, and asset ownership. and how they build strategies that benefit from the system instead of fighting it. And don't forget, go to stockcastbonus.com, download your free resources. That's where you start understanding the rules of the game. Stick around. We'll be right back.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to Rich Dad StockCast. All right, Andy, before we talk strategy, I want to talk about history. And the history of the Fed is very interesting. Maybe not a lot of people know about it. Can you enlighten us a little bit? Can you give us a little history lesson?
Yeah, the best book I've read on the Fed's history, people know what it is. It's Edward Griffin's book, Creature from Jekyll Island. And it's a great read. He's a conspiratorial guy, but this had a lot of conspiracy to it. Reminds me a lot of my grandpa. My grandpa was a metallurgist. He was a gold bug, and he just has the same views as G. Edward Griffin. And he's been on my podcast before. He's a great guy. I've spoken on stage with Ed Griffin. Wonderful man. But the way it started was you had these wildcat banks all over the United States. And a wildcat bank means, you get them further and further from town, out where the wildcats are. And every bank could issue their own currency. And it was called specie was the name. Like gold coins, gold bullion was called specie in those days. And so you'd say, look, it's backed by gold here. Look at our big, chest of gold here in the safe, back in our notes. And of course, they would just print the money and, the notes, they'd lie. And it was just really out of control, all these wildcat banks. And so they decided, hey, we need to have a national type of federal reserve here. So I think it was 1913, I want to say, same year income tax came about, by the way. And all of the elites, the Rockefeller type guys, Morgan type guys, a bunch of congressmen, it was really clandestine. It's, Ed Griffin tells the story. It's like a movie. They get on this plane or on this train and they use fake names. They borrow their neighbor's shotguns. So they go into the guise of a duck hunting trip. Literally, this was a secret meeting. So all these elites and, bankers from New York and all the rich guys and congressmen, they go down to Georgia. And off the coast of Georgia in the Atlantic Ocean, there's an island off the coast called Jekyll Island. And, it was kind of an aristocratic, country club type of island. And you go out there and on the wall in the room, they did it. There's a little plaque on the wall. In this room, was made the Federal Reserve or whatever it says. And they decided to do central banking. So that's how it was born. Very clandestine. It is not a government agency. It's held by its member banks. In other words, if you're a member bank, you have to have stock and buy stock in that bank and have ownership of it. So the ownership is spread out privately and owned by corporations. It's not a government agency, but the government has oversight. So President nominates the chair, Congress has oversight supposedly, and they work together, but wasn't really a bank when they started it. It wasn't really federal, and it had no reserves. So Federal Reserve Bank, none of those were really true. Now they'll take deposits. Back in 2008, they started paying money on deposits, but that history is important. We haven't always had a Federal Reserve, and now that we're the world's reserve currency, it's a big deal. I don't know how long that'll last. The U.S. being the world's reserve currency, I'd imagine for the foreseeable future it'll last. But the Fed's an interesting monster to study.
It's so fascinating. I remember Robert saying kind of what you just said there. The Federal Reserve, it's not federal. There is no reserve. There is no bank.
There's no bank. Yeah.
Crazy to think about.
Best talk I ever heard Robert give was on the Federal Reserve. In all the years I've seen him speak, nothing comes close to this speech. It was amazing. We were with Bob Helms and Robert Gray on the Real Estate Guys Real Estate Cruise. It's a great event. They do it every year, and they'll often invite they'll Peter Schiff goes all the time. They had G. Edward Griffin there, and G. Edward Griffin on one day gave a speech to all of us called "Abolish the Fed." Talked about all its problems. Next day, Robert speaks, and he said, "Be the Fed." That was the name of his talk. Be the Fed. It was the best talk I've ever heard him give. You hear Edward Griffin, boy, we got pitchforks and torches. Yeah, let's tear down the Fed. This is terrible. This is corrupt. Blah blah blah. And then Robert talks, and you're like, man, the Fed's the best wealth creator ever. And it's just more about moving with the tide and going with the flow. If you fight the Fed, you're going to lose. So if you work with the Fed, you're going to win. And boy, I can't tell you. I mean, Robert talked about his time in Vietnam and how people knew the gold price, and just such a great speech called "Be the Fed." And the fact they print money out of nothing and we can participate in that and use that money as investors, absolutely fabulous. Best talk I've ever heard Robert give, by far. Best one ever. It was amazing.
That's phenomenal. Now that actually is a good segue into my next question when we shift to strategy. And so, as we're thinking about strategy, how can investors use inflation? How can investors be the Fed?
Yeah, well, we talked a little bit about real estate and how you can borrow money and short the dollar, and that's why it really works. Real estate's great. People bash asset classes. Well, I like real estate and I hate business, or I like business and I hate stocks. To me, it's just cash flow. I'll take it. It's spendable, investable. So the other reason I really like understanding how inflation works, it helps me balance what I do. I'll have a little gold in there. I'll have some debt for some real estate, but you look at how it can benefit inflation. I have stocks now that are paying higher dividends where you're getting a double-digit return just off the dividend. Why? Inflation. I have stocks that I bought in the double digits that are now, into the healthy triple digits. Why? Inflation, right? The dollar becomes worth less. And so it isn't that your wealth necessarily grows, but it's maintained because you own things other than cash. So why people, it's so ironic that we go to work 40 hours a week to get something that's losing value. It's exactly the wrong mindset. If you threw a bunch of cash on the floor in a public place, people turn into animals. They go from social to primal, on their hands and knees, grubbing up that money, but they're chasing something that's losing value over the long term. It'll eventually, wind up in the landfill. It's just paper at the end of the day. So they chase it and chase it and chase it. I would rather have an asset than a dollar any day of the week, man, any day of the week. And what entrepreneurs do is as soon as we get that dollar, we try to get rid of it as soon as possible, or investors as soon as possible, to replace that dollar that's losing value with an asset that can hold its value. And when you talk about value, stocks are valuable because they serve people. It was our Buckminster Fuller who said, the more people I serve, the more effective I become. There's no way you can serve more people faster and become an owner. You become an owner of Coca-Cola, you're now providing 2 billion soft drinks every day for people, daily. You're literally, serving 2 billion beverages a day. That's just a generalized principle. It's true in all cases, including stocks and real estate. If you serve people, you do well, and you just can't run from that. It's just a fact. And so as inflation happens, dividends go up, stock premiums go up, or option premiums go up, stock prices go up. It's fabulous. I love inflation. Absolutely love it.
Now, sake of time here, if someone wants to stop losing ground to inflation and start playing smarter, getting better, what's the first step they should take this week?
Well, get educated, learn about the Fed. I've got a class that I teach. I don't charge people for it when they enroll. Well, I guess I charge people when they enroll as a student in the Cashflow Academy. I add on that class for free. And it's just called "Don't Fight the Fed, Make Money Instead." That's the name of the class. And it's a deep dive into all the levers that they pull. How does the repo market work, or the reverse repo market work? And how does that affect, mutual funds, protect them from breaking the buck, so to speak? There's a lot in there. What is the lender of last resort? How did that affect Silicon Valley Bank? All the interplay between the Fed and the Congress in fiscal and monetary. And you can start just go to cashflowbonus.com, start with that, start with the free stuff. And if you like the way we teach that, it's worth enrolling in some more formal classes. But, I'm a financial education advocate. I live it and breathe it every day. I practice what I preach. I buy the assets, and, that's a great way to learn. It's just by doing, getting mentors, study.
There we go. Well said. Well, listeners, the system isn't broken. It's just not explained well. And thank you, Andy, for explaining it well to us. We appreciate it. And once you understand how money actually flows through the economy, you can stop reacting and really start positioning yourself. And if you want to start thinking like an investor who understands the system, go to stockcastbonus.com right now. There you'll find those free tools and resources Andy was talking about that help you to build real financial awareness. Now, if this episode opened your eyes, make sure you like it, subscribe it, share it with someone who deserves to understand how money really works. You're not here by accident. You're building something that most people won't. So stay smart, stay invested, and we'll see you next time.
Thanks, Del.
This podcast is a presentation of Rich Dad Media Network.